To another episode of The Starting Block. Let's take a look at the market, see what's going on. Bitcoin hovering around 40 grand. We've been doing that around 14 days now, if you look at the charts. We're going to see a lot of chop action in the next couple weeks, maybe months. A lot of people saying that there's a bear market coming. You have to decide what you're doing. Are you investing or are you trading? If you're trading, it might hurt a little bit. If you're investing, just know everything will come back. I think we're like halfway through going into the halving, which right now Bitcoin is producing 6.24 Bitcoins per block reward. And after the halving, that'll be cut back in half, and that's usually what kicks off the bull market. Ethereum doing pretty much the same thing, right around 3 grand. Yeah. All right, guys. Some news coming out. Solana yesterday went down. Some outages reported by an NFT minting project called Candy Machine. This is around the 7th time this has happened. It's got people who are blockchain enthusiasts worried about what's going on with Solana. Another news, ApeCoin released over the weekend virtual sales for lands. It looks like it raised around $285 million worth. A lot of hype and also some problems that happened with that sale. It was on the Ethereum blockchain, and it looked like just to mint these were thousands and thousands of dollars, pretty much pushing out retail investors from doing so. Another thing, I know we covered DeGods a couple weeks ago. It looks like they're taking ownership and a stake in the Big Three league. Big Three is former NBA players professionally playing ball. This is huge for DeGods and the DAO. They get their faces out with a massive potential for sponsorships and endorsements. I mean, they're going to own a team with Microsoft, it looks like. And this is a fairly new league. It's been around for a couple of years, but takes place over the summer and drives huge TV audience through. We'll have a logo patch opposite of Microsoft on the team jerseys. Great things. I mean, this is probably what you're going to start seeing from now on is crypto and blockchain companies going into major deals, whether it be sports or anything. You know, the Staples Center got renamed, and that's, like I said in another podcast. If you guys aren't following the money in the news, what's going on, you guys are going to be missing out a ton. Loaded show today. We're going to be talking about the differences between proof of work and proof of stake and some of the energy consumption that goes with it, and the narrative about blockchain being bad for the environment. So let's dive right into that. In blockchain today, the major ones being proof of work and proof of stake. There's others like proof of burn, proof of history. But today we're going to be covering proof of work and proof of stake, guys. At the center of every cryptocurrency lies a network of computers that helps secure the software from attackers and regulates the issuance of new units of its supply. This system is called a consensus mechanism. We covered a little bit about consensus in the first video. The network of computers need to agree on what is true and not true. Everyone has a copy of the public ledger, and nodes need to agree to push transactions. In order to reward miners with Bitcoin, the currency uses a proof of work function. The same function is used in a number of altcoins and is based on the SHA-256 algorithm. So here's a list of proof of work coins. A lot of them you probably never heard of or probably will never hear of. But that's the list right there. So proof of work algorithms determine who can adjust a ledger through a competitive race in which a certain participant, which are miners, are encouraged to expend computational energy in order to propose valid blocks that meet the rules of the network. Nodes, which are any computers running the Bitcoin software, then validate transactions, prevent double spending. Double spending is the act of spending the same funds to two separate recipients, and determine whether proposed blocks should be added to the chain. In order to create a new block, miners on a proof-of-work network compete against each other to solve complex mathematical problems in a process called hashing. These puzzles are very hard to solve, but it should be easy for the network to verify the correct solution. In order to do so, miners guess a string of numbers called a hash. This is when it combined with the data provided in the block, and when passed through a hash function computer, must produce the result that matches the given conditions set out by the protocol. The winning hash is subsequently broadcasted to the network for the other miners to verify whether the solution is true or not. If it is correct, the blockchain gets added to the block. The block gets added to the blockchain, and the miners get compensated with a block reward. The block reward gets cut in half every 4 years after the halving. Right now, the reward for Bitcoin is 6.24. Some of the advantages of proof of work is a higher level of security compared to other consensus mechanisms. But some of the big disadvantages of it is lack of efficiency, and the process can be slow with high fees. You also need a massive amount of energy to function. That's some of the topics with the environmentally friendly today. Also, expensive hardware, guys. You need to keep up with it, and vulnerable to a 51% attack. A 51% attack is an attack on the blockchain, which hypothetically, a group of miners who control more than 50% of the network mining hash rate could interfere with the blockchain and prevent new transactions, confirming and halting payments between users and double spend coins. Moving on to proof of stake, guys. This is a list of proof of stake blockchains currently. Ethereum will be moving there in Q3, the long-awaited merge. Proof of stake is a modification of the proof of work introduced in 2012 as a means to solve its perceived dependency on energy consumption and determine blockchain ordering. Rather than rely on computers racing to generate the appropriate hash, the idea behind the proof of stake protocol is that participation is determined by ownership of the coin supply. Using a set of factors determined by the protocol, the proof of stake algorithm pseudo-randomly elects a node, anyone who owns the coin, to propose the next block to the blockchain. When the node gets elected, its role is to verify the validity of the transactions within the block, sign it, and propose the block to the network for validation. Users need to stake their coins in order to participate in the verification process. No expensive hardware needed in order to qualify for the verification process. One needs to store a certain amount of coins in the wallet. Once qualified, the voting system will choose the validators. The more you stake, the more you can mine or validate new blocks. Advantages of proof of stake, it's highly efficient consensus protocol as it does not need heavily computational power to function. Faster transaction speeds than proof of work, and in the same blockchain, the fees can be very inexpensive. Some disadvantages is that the process is not as secure compared to proof of work. Validators with large positions can influence verifications. True on some blockchains, but not on all. ETH is merging to proof of stake during this Q3, where all validators are programmatically guaranteed to provide the same rate of return for all stakers. Will also make ETH deflationary. Depending on the blockchain, you will need to lock up your coins for a long period of time. In proof of work and proof of stake, the blockchain is a mechanism that consists of a string of blocks aligned in chronological order based on its transaction. The first block in the proof of stake blockchain is also hard-coded into its software and is commonly named the Genesis block. The subsequent blocks added to the blockchain always refer to the previous block and contain a copy of the full updated ledger. Of note, in proof of stake cryptocurrency, there is no competition who is selected to add a block. As such, the blocks are often said to be forged or minted rather than mined. Key differences in energy use, guys. Unlike proof of work blockchains, proof of stake blockchains do not determine who can propose blocks based solely on computing power and energy consumption. Proponents often build proof of stake as more energy efficient, in which individual nodes are assigned the responsibility of creating new blocks rather than competing against other nodes. Because proof of work mining and proof of stake minting both require energy consumption, mining and minting nodes are motivated to use the cheapest form of electricity possible, which most often comes from renewable resources such as hydroelectric power, wind, solar, rather than greenhouse emitting sources like coal. Further, proof-of-stake blockchains are required to use specialized hardwares like GPUs. Proof-of-work mining components and other computing devices require resources to produce. The participation, users who want the opportunity to be selected to add a block on the POS blockchain are required to stake or lock a certain amount of blockchain cryptocurrencies in a special contract. The amount of coin staked determine their chances to be selected as a next block producer. In some cases, if users behave maliciously, they may lose their stake as punishment. In order to not always favor the wealthiest nodes, proof of stake may involve other determining factors. They may include the amount of time a node has staked their coins, as well as pure randomization. Also, reward distribution, guys. Similar to proof of work algorithm, the block reward in proof of stake refers to cryptocurrency awarded by the blockchain to the user who proposes a valid block. However, a block selection is done by coin ownership. Exchanges may offer staking services that offer users the ability to stake funds on behalf of the exchange for more regular payouts. Quick note on that sustainable energy. Bitcoin is becoming more eco-friendly, up 60% over the last year. They're using more things to produce their mining procedures. They're doing hydro, wind, solar, nuclear, geothermal. Some countries are even using volcano energy to mine Bitcoin. You'll see right here a little mix of the top countries compared to Bitcoin and renewable energy. Speaking of energy, Bitcoin has come under a lot of scrutiny in the media over the last year as its popularity and demand has risen over high energy usage and high carbon footprint. A lot of false narratives are being shown that Bitcoin is bad for the environment, but compared to other industries, Bitcoin is significantly low. Yes, Bitcoin uses a ton of energy. However, over the years, Bitcoin mining companies have transitioned to renewable energy, and the number of renewable energy has increased in about 58%. Just like going into gold, the amount of carbon emission that's needed to do that for jewelry or investments or electronics, they take into effect everything, mining, milling, concentration, the trucks, the tires that are used on the trucks, everything goes into that. Gold and banks are commonly referred to with Bitcoin in energy consumption. Banks, you have to look at everything. Bitcoin is more often compared to them because of the banking system, such as payment, savings, settlement, and gold, the non-sovereign store of value. Unlike the banking system where it requires multiple settlement layers, Bitcoin only offers one settlement. The banking system has four key areas of electricity consumption: bank data centers, bank branches, ATM machines, and card network data centers. Hope you enjoyed it. We gained a lot of useful information between the difference between proof of work and proof of stake and the energy usage. Success and nothing less, guys. See you on the next episode. Thank you. Sponsor for the video, All Mine Law. Most people want to get into crypto mining but don't know where to start. All Mine Law is a company specialized in crypto miners and mining services. Their goal is to make crypto mining more accessible to the average consumer by providing an online shop with the newest miners that can be shipped right to your door. They also provide a hosting service if you want to get into crypto mining scene without having to spend hours on how to actually set one up. This will cover setup, housing, and maintenance, and will get you mining quickly without so much hassle. If you'd like to check them out and get more details on what they do, or just want to check out the selection of miners they have, the link to their website is in the description below. You can also reach out to them on most social media platforms or schedule a call. Those will also be in the description below. Thank you again, All Mine Law.